Back to yours box. In this video I'm going to take a look at the S&P 500, the weekly close. If you like this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So if you've watched my previous videos, you know that I wasn't really banking on it happening, but again, I wasn't really surprised. Again, I wouldn't have been surprised by a possible rally, even dramatic rally towards the bull market support band. So from low to the bull market support band, something like a 7% rally. I wouldn't have been surprised by it, given especially the fact that ever since the non-farm payroll report, March has generally been not great, not terrible. When it comes down to the economic data, granted we'll get PMIs next week, but I'll touch on that a bit later. But again, coming back to what the data has been so far for the month of March, what is really bugging me about the S&P and the S&P 500 and equities in general is that this week in particular, given also the fact that you had even the Fed speak come out and be quite benign in reality, you didn't see a real convincing response. Like if you look at initial jobless claims so far, now again, in my previous videos, I've said many times how my expectation is that, again, nothing dramatic, but over the next few months and going into the summer, I'm expecting more of what we saw last year. So a bottom in January, and a slow drift higher towards the summer. Okay. Having said that, so far for the month of March, each jobless claim report has been somewhat benign. The latest number is 223. Again, my kind of line in the sand when it comes down to jobless claims is 215 and 220. Anything 215, anything below 215, you can generally expect the next unemployment print to be lower. Anything above 220, you can expect the unemployment rate to go higher. And again, so far you didn't really get anything dramatic with the initial jobless claims. Granted, continuing claims are still near the range highs. Now, again, historically, we're still, the chart speaks for itself. Okay, we're still way off. The highs. We're still at relatively low levels. Having said that, we are still around the highs for the cycle. On the inflation side, just looking at the headline inflation, we also had constructive news come out of that. You had inflation come in at 2.8, and again looking benign. Now it is true that PPI came in again also quite somewhat cool, but the components that make up PPI are really pointing towards a somewhat hotter number on Friday 28th. But in any case, it's nothing game-changing, okay? The data so far in March has been, again, not great, not terrible. And if, I just had to, put my finger in the air and, give you my honest opinion, I'd say that I was expecting something more out of this week, given the fact that everything that could have gone wrong so far didn't or hasn't gone wrong. And the problem is that you haven't rallied. You haven't taken this as a chance to rally, and now you're just back to square one. You're being held hostage by the economic data. So, for example, if next week we get PMIs and they come in weak, now I'm not saying they'll come out weak. They could very easily beat, and one of the reasons why I'm looking at these the PMIs next week is because if you recall, last month the PMIs really painted a picture that is more consistent with what we saw in the summer, rather than what we saw from September till January, leading people to really reconsider everything that we saw from September to January. Was that just a result of many momentary factors, such as tariff saber rattling and people front running tariffs because of announced port strikes in September? Again, people trying to front run any potential strike. Natural disasters. You had the hurricanes and you had fires. Okay, so you really had a lot of momentary factors play into the numbers. And again, the reason why I'm waiting for the PMIs is really just further confirmation, or really the PMIs dismissing what we saw in February. Okay, and coming back to the S&P 500, the problem is that you haven't rallied so far. You're still really flirting with the lows that were put in the week before. And ahead of you, you have the PMIs, which, again, we'll see how they come out. But if they come out negative, that's just more pain. Because, again, I strongly feel that at this point, a lot is, it's about the economic outlook, okay? If you have any confirmation that we're somewhat closer to last summer, that's going to hurt equities. And potentially what you saw with FedEx, let me see while we're at it, how they closed. Okay, then it was still better than a negative 10% on FedEx. But if you saw their earnings report, they're really painting a dimmer picture. Same thing for Nike, or Nike, however you want to pronounce that. Again, I don't want to extrapolate too much out of these companies' earnings, but going back to square one, to the S&P 500, again, we haven't rallied. Second, we have kind of bounced off of this yellow squiggly line, all right? It's kind of that's held support here, and on the 7th of March, it's kind of potentially turned into resistance. Now, again, at this point of the cycle, I'm not really a fan. I've made that very clear in my previous videos. I'm not a fan of technical squiggly lines on charts. Because again, if next week the PMIs come out and they beat, expectations are for manufacturing at 51.9, so a slight decline, and services at 51.2, so more or less the same. If the PMIs come out and they paint this nirvana, okay, everything is great, the squiggly lines aren't worth anything. The economic outlook is looking better, more optimism, and we can shrug off any weakness. If, however, the PMIs come in below expectations, confirming what we saw last month in the last PMI report, again, the squiggly lines aren't worth anything. They're just squiggly lines on a chart. So again, I'm still in the camp that we are being held hostage by economic data, okay? And the fact that we haven't taken the opportunity to rally in a more significant manner is, to me, confirmation of exactly what I've said. We're still waiting to see where exactly are we, okay? So really, it's up to your interpretation of where we are in the cycle. I lean towards the US being in a slowdown, and currently the things that are weighing a lot are tariffs, fiscal tightening, if that's what you want to call it. And fiscal tightening really is Doge. And again, when it comes down to Doge, I'm not so worried about the numbers. Okay, when you see, oh, you got 200 people layoffs, yeah, of course, that's important. But what Doge's input in the system is really again, more uncertainty. Because imagine you are a federal employee. Well, the fact that you have this kind of sword hanging over your head by itself is, well, it's going to curb your enthusiasm, if that's how you want to put it. Because the fact that you know that there's the potential of losing your job, already that is, it's going to hold you back. Okay, you're not going to potentially spend more. And if you do get laid off, that layoff turns into people around you, the people that surround you, losing that income as well. So imagine, again, as I've said many times before, the examples I've used is a restaurant that is near a federal office. The federal office that maybe, is being rented from a private investor. You don't have that income anymore. It's all these small things that are around federal employees that get impacted, and that is the real effect. You also have, I see Neil Data from Renaissance Macro point this out a lot, is that a lot of the pandemic era spending at state level has dried up, and you no longer have that acting as a tailwind. So really, the reason why I've shifted from Doge to fiscal tightening is really because I think fiscal tightening is a more appropriate way of painting the picture around what is happening at with the layoffs, and generally speaking, just the government having less of an impact on the economy. And again, that will cause some economic harm. Okay. So again, you have tariff saber rattling, which is creating uncertainty. You have fiscal tightening that is creating uncertainty. And then you have the cherry on top, that is the yen carry trade. I made a video today if you feel like watching that. So again, to keep things short, is a rally out of the cards? Absolutely not. Again, I would not be surprised if we get some kind of any kind of news that kind of gives the market an excuse to rally. Okay, it could also be, by the way, the tariff announcement on the 2nd of April. It could very well be that the 2nd of April comes around, everybody is worried sick about what is Trump going to announce. But just because something gets announced and you know what framework you're working in, that's like, at least you know what you're working with. I think the worst possible outcome on April 2nd is that they get postponed. Okay, so any kind of tariff gets postponed, that would be one of the worst outcomes for equities. Because again, it's still more uncertainty, and that means not knowing where you are, and not knowing where you are is really a killer for equities. So again, I'm looking for any kind of data that can provide a bounce. Does it have to happen? Absolutely not, especially if, again, as I said before, we have the PMIs come in next week, possibly lower. They don't have to come in lower, but again, if they do come in lower, they'll probably paint a picture that is similar to what we saw last month. Okay, and equities will have to face the music at that point. But again, I don't want to get too ahead of myself. I'll leave it at that, and again, we'll see how the data comes out next week. If you like this kind of content, consider leaving a like. And as usual, nothing is financial advice in this video. I'll see you next time. Bye.